So it appears that Shift has lost everything, and they could be going under. The stock just hit a new low, Canton Fitzgerald downgraded a few days ago, and the selling pressure has not stopped. So in this video, I'm going to share my thoughts about some of the recent news that has been released, as well as talk about what I'm planning on doing with the stock that I've shared numerous times on this channel. Shift hit a low of 60 cents back on June 16th, and for about a month and a half, the stock went on an absolute tear, reaching a high of about $1.50. But now the stock has fallen back down to new all-time lows. And this fear has led many people to question whether or not the company is truly going to survive in this recessionary environment. But I want to make sure we cover all of our bases so that we are confident in whatever decision we end up making with this company. First, let's talk about the downgrade. Canton Fitzgerald announced that they are moving from a buy to neutral and switched their price target from $2.50 to 90 cents. Now, at this point, the company was trading just under 70 cents. So the question we should all ask ourselves is, why did they downgrade? Was it something related to the macro economy, or did it have something to do with the business? Their reasoning is because used vehicle prices are declining faster than expected, which lowered their estimates. Higher auto rates also negatively impact car affordability, which lower used vehicle sale volume. And the last reason are the uncertainties of the merger with CarLotz and Shift's ability to reach positive free cash flow. Besides the first part of their argument, it appears that a lot of this has to do with their perception of the business. So let's look at all those different factors so you can make the best decision for yourself. When we look at the revenue guidance before their quarterly report, they were expecting to have between $1 billion and $1.1 billion for the year. But for the second half of the year, they are now only expecting between $270 and $290 million in revenue. That means that they will have a total between $690 and $710 million. So this decrease in revenue projections looks horrible. But with that being said, we need to ask the question, why would Shift reduce the projections by that much? Is it because of lower demand for used vehicles? Even though this could be the case, the greater reason in my opinion is because they want to reduce costs by switching to just using their online platform. By reducing costs, they will be in a better position to execute on their merger with CarLotz. If we look at both of these companies, they had one thing in common. They lacked profitability, but the way that they were getting to that profitability was completely different. CarLotz, which is a leading used vehicle consignment business, has their presence in the Mid-Atlantic region. Shift, however, is more focused on the technology side of things, and their presence is in the West Coast. Looking at their operations, the merger will be synergistic because while Shift runs a service that includes the purchase, maintenance, and selling of those vehicles along with their online platform, CarLotz's business model is more focused on connecting sellers to the retail buyers. Not only does the combined company get both business models, but they also get to use these business models in new locations. Shift has always wanted to expand to the East Coast because there is a huge market there. But the biggest issue was the operational expenses needed to run a hub on the other side of their headquarters. CarLotz will also have the ability to use their business model on the West Coast, but that is not the only thing that benefits both of these companies. The biggest reason I believe many investors chose to stay away from the used car e-commerce sector is because of their razor-thin margins. So it's difficult for companies to get to profitability. As we have seen with companies like Carvana and Vroom, cost reductions are key when we talk about gross profits per unit, which is one of the most important metrics in this sector for evaluating a company's progress toward profitability. The merger allows CarLotz to have massive cost reductions because of Shift's online technology, which is much more advanced, that they have already stated will be their main source for generating sales for the rest of the year. And this means that you won't need as many people on your staff to value vehicles. But they really needed an increase in their inventory, and that is something that CarLotz can bring them because of their connections with corporate vehicle suppliers and their current physical locations. Before the merger, Shift was expected to be profitable in 2024 or 2025, and if I'm honest, they did not have the cash to get themselves to profitability. So not only did both companies need the cash to get them to the point of becoming profitable, but they also needed a path to actually get them to profitability because the entire used car e-commerce sector is struggling. And I think one thing that made investors relieved is the business plan is expected to be fully funded to profitability from the cash position of both companies. And this is the reason why I think that they are reducing the amount of vehicles that they are selling. By being a cash losing company, they want to reduce the amount of cars sold. That way they can preserve more cash so that when this deal goes through, they will have the cash to fund them through profitability. In terms of when each business will become profitable, here are the most recent statements. Shift is really focusing on their online presence, and because of their operational changes, they will be reducing the workforce by 60% across their corporate positions and frontline roles, which will significantly reduce overhead costs. When we look at the business now for Shift, they are in a much better position overall to get to profitability. Plus, their shift to the online presence will also reduce expenses, which will give them more cash when it comes time for the merger. With the new business model, the company is projecting positive unit economics in 2023 and company-wide profitability in 2024. And the best part about this is that they are not anticipating needing additional capital for break even, which is significant because that has always been a stress for Shift shareholders. Carlots, on the other hand, is expected to be break even in 2023. So why would Carlots want to merge if they had the potential to break even sooner than Shift? I think it all comes down to competition. Their CEO, who just so happened to be the former CEO of a company I currently own called carparts.com, said it best. What became clear is that from a technology and product perspective, we were really behind some of our competition. Carlots recognized that even if they could achieve profitability in the next year or two, they would not be able to keep up because they did not have a strong enough product. Their physical locations worked well, but their online product just wasn't good enough. And if we look at where the world is headed, it is going to be away from physical locations and moving online. But this also tells me that the CEO really wants this merger to go through. You don't humble yourself to say a company has a better product than you. And I believe Shift feels the same way. The company is making a lot of management team moves, with Jeff Clements becoming CEO in September. And honestly, I think this is hands down the best move for the company. When it comes to Clements' expertise in leading the team for Walmart.com, it puts the company in the best position to not only succeed on revenues, but generate solid profits as well. And he is going to be the CEO over the combined company as well. And this is where I want to talk about something that I believe is extremely important for understanding the new business model. Many people simply look at revenues as a leading indicator for how well a company is doing. But when you think about it, if the company grows revenues 5x year after year and they are still a money-losing company, they could still run out of cash. So what's actually the most important thing for a company? Getting themselves to profitability. And so all of these changes, from cutting workers, moving to an online approach until the merger, and moving to more value vehicles to focus on GPU, demonstrates that they don't care much about growth right now. And especially in this economy, I think that is smart for Shift. Alex Hormozy, who is a really popular business guy on YouTube, I believe says it best. As you scale or put more in, your margins begin to compress. And then you get in this place where you have to keep selling to maintain your overhead, but you're not really taking enough home and you can't have enough cash flow to grow the business. This is exactly what we saw happen to Shift. So what is the answer? Well, Hormozy goes on to say, sometimes you have to take the step back, fix the infrastructure that everything is built on, and probably hire and fire some people that you promoted a little bit too early that didn't have the experience because they're actually not running things that well. Shift is doing just that. They are reducing their channels to being online so they can reduce expenses. They cut jobs in order to have better margins. They are focusing on value cars to improve their gross profits, and this puts them in the position to where they can focus on getting to profitability. And once they get to profitability, then they can begin to focus on growth. But if you don't have a profitable business, your revenue growth can only take you so far. So how does this combined company get closer to profitability? First is their shift online and having lower volumes. With Carlots already close to being profitable, plus Shift's online checkout, they won't need as many transactions to achieve that profitability. Second, they are placing their attention on high margin units. Rather than needing to sell higher volumes, they can focus on value cars that will give them the best return, which will improve their gross profits per unit. Value vehicles are those 8 years or older or that have 80,000 miles. The third way to help achieve profitability is through automating much of their operations. They have done this through their temporary elimination of in-person test drives and switching to their online checkout channel. This could reduce about 40% selling costs per unit, which helps drive margins up. And the last way is through reducing their marketing expense and reducing corporate headcount to reduce overhead costs. Both of these are going to put the company in a position where they can reduce cash burn while still being able to grow their customer base. Now, there are some things that need to happen in order for this merger to go through. First is that both Carlots and Shift shareholders need to approve the merger. According to Carlots, the board already unanimously approved the merger, and other institutional shareholders like Vanguard will more than likely approve the deal as well. Shift's management team has already approved the merger, but we are awaiting Lithia Motors, who owns about 16% of the company. However, because they have been partners for a while and have helped Shift in several different ways, like obtaining the floor plan financing, I don't see them wanting to vote against the merger. Now, when it comes to cash required for the merger, here's what both companies need in order for the merger to go through. Shift will need approximately $10.5 million and CarLotz will need $58 million. Now, some people believe that because of the amount of cash burn, they will need to raise equity. But based on the moves that they are making with doing online purchases, shutting down their Texas hubs, and the amount of jobs that they are cutting, I don't think that they will need to. Also, the team at Shift expects to have a combined cash position of about $125 million upon closing, which will enable them to fully fund their updated business plan. And as I said previously, they believe that there will not be a need for additional capital to reach break even. Now let's talk about how the shares from CarLotz are going to change when the merger happens. As of now, under the current terms, CarLotz shareholders are expected to receive almost 0.7 shares of Shift common stock for each share of CarLotz. But please note that the actual exchange ratio will adjust at closing based on Shift's outstanding shares relative to CarLotz fully diluted shares. As of right now, the transaction is expected to close in Q4. And if I had to take a guess, I'm assuming late Q4 because Shift even says that CarLotz will not have an effect on the second half numbers. The board will consist of 5 Shift board members, 3 CarLotz board members, 1 mutually agreed, and then the CEO, Jeff Clements. So those are the logistics of the merger itself. Now, I want to touch on something that has gotten everyone freaked out, and that is the possibility of the reverse stock split. On October 7th, it was reported that Shift is not compliant with current NASDAQ standards. This means that the company has a period of 180 calendar days from the date of notice, or April 3rd, 2023, to get back to fulfilling the NASDAQ standards. The thing that I believe many people missed was the possibility for a reverse stock split was announced back in August when the merger was announced, but it wasn't mentioned until September 26th when it was announced what is going to happen at the special meeting, and this frightened many people. But I want to ask a key question. What actually makes the reverse stock split bad news? What I believe is that reverse stock splits are associated with bad companies who ended up either going bankrupt or failed to get back to where they were, and so anytime that word is mentioned for a company, it leaves a bad taste in people's mouths. But Shift is going to probably do the reverse stock split to get back to being compliant. Does the reverse stock split affect their overall business? No. And so we need to understand the actual reason for this kind of news. Let me put it this way. Shift is outperforming Carvana and Vroom, which are their top competitors in the space. I think much of the fear is in the fact that Shift is under $1, and because the reverse stock split has a negative connotation, it appears that the business is failing. However, even though many people believe that reverse stock splits are horrible news for a company, this isn't always the case. In fact, in 2011, CNBC did a report that showed there were numerous companies who succeeded coming off a reverse stock split. Companies like Raytheon, CBS, Discovery Communications, and Time Warner all performed exceptionally well following the reverse stock split. And this is why it is so important to understand why the company would take this route. Now, there are a couple of things that I want to mention about this news that I believe needs clarity. First is that the reverse stock split will occur after the merger goes through. This is important because it won't have much of an effect on the Shift to CarLotz exchange ratio. Secondly, Shift can have a ratio of 1:5 or 1:10. I firmly believe, assuming that the merger goes through, they will probably go for the 1:10 so that they are well protected from falling back under $1 again. But we will see what the company does after the merger. That being said, this merger has not officially gone through yet, so please consider that before buying this stock. If we see a delay in the merger, we need to ask the question whether or not these companies can last when we look at their cash burn. We have seen companies over the past few years enter a merger with another company that fell through. And even though there are plenty of signs that point to the merger going through, I remain cautious with my position in this company. I recognize that this continues to be a risky play, and that is a major reason why it is one of my smallest positions in my portfolio. It is roughly about 5% of my entire portfolio, which is barely anything. It's like if you invested $100 into your Moomoo account, link below down in the description, out of that $100, only $5 is for Shift. If that $5 went to zero, then so what? I'm sure my top companies will easily make up for that $5 and much more. That is what we need to consider when investing in the stock market. There is still a possibility that this company could go under, and I think that is something that everyone needs to consider before buying or adding shares to this company. So please know your risk tolerance before investing. In terms of buying, I'm only adding a few shares as long as it remains under 75 cents, but I need to say that it's my smallest add because of the risks I mentioned previously. I still want to continue to have this one as a small position so I'm adding much more aggressively to my other companies. Hope you all enjoyed this video, and if you did, smash that like button down below. That helps more people see this content. Also, I would love to hear your thoughts, what you think about Shift, whether or not you think it's going bankrupt, or if you think it's going places. So let me know your thoughts in the comments. And if you're new here, hit that subscribe button and notification bell. That way you are notified when new content comes out. Hope you all enjoy the rest of your week, and I'll see you in the next one.